Good day to everyone on the webinar. I'm Dwayne Dippenaar, and today we're going to unpack the Nedgroup SA Equity Fund. So if we first examine what's happened year to date so far, you can see the SA Equity Fund down 1.2%. So having quite a tough year, slightly behind the cap Swix, the benchmark, about 90 basis points. But if we really unpack what's driven the SA equity market so far this year, it's been domestic SA equities up about 3.5%, so recovering from a tough start to the year. And the dual-listed stocks on the JSE up 4.5%, also performing okay, but not a fantastic year so far for the JSE. The real drag has been resource stocks on the JSE, and you can see the Resi 20 index down 15% so far year to date. And that was on the back of a strong start in January and then weak data coming out of China on the reopening there. So pretty disappointing reopening from China. The rand is weakened against the dollar by 10%, as you can see from the chart there. And that's really driven any US dollar investment. So you can see the emerging market index up 13%, 10% of that, obviously the weaker rand. But it also points to there's no real contagion from EM into the South African market. And South African market underperformance really to do with resources and domestic issues. On the other hand, you can see the MSCI China up only 3%, so in dollars down 7%, so under a lot of pressure, and that really is the tough economic situation in China at the moment. The standout performer has been the S&P 500. You can see up 25%, 10% of that once again rand, so up 15% in dollars, down 5% from its peak, but really a very strong performance from the S&P so far this year, but a relatively narrow rally. And that was really driven by 7 big tech stocks there and the excitement around AI, driving stocks like Microsoft, Nvidia, and Tesla higher this year. This is just a graphical representation of the fund and its performance since inception. And you can see the fund's both outperformed its benchmark and peers since inception quite handsomely. If we then unpack that performance over various periods, as I mentioned, year to date, you can see the fund having a tough year, underperforming the benchmark by 90 basis points, and that year-to-date performance really flowing into the one-year performance. But over more meaningful periods on an annualized basis, 3 years, 5 years, and since inception, the fund's still outperforming both its benchmark and peers with over 2% alpha over a 3-year annualized period. What I find more interesting is the table below the chart, where we look at the consistency of the performance of the fund. And over any 5-year rolling period, you can see the fund has outperformed its benchmark over 85% of the time and outperformed peers 80% of the time, really pointing to the consistency of the fund's outperformance over time. If we then stand back and look what the key drivers were for the fund year to date, firstly, on the positive side, at the beginning of the year, we were very constructive on the insurance names, so we had large positions in Sanlam and Momentum that had done very nicely for us. We were underweight or had no position in Sibanye-Stillwater, and we know the platinum group metals have come under a lot of pressure, and that obviously helped us. So that was a negative detractor for index, and we had none of that. But on the negative side, we had overweight positions in Impala and Northam, our preferred platinum stocks, and with platinum group metals under pressure, that cost us. That being said, we have seen the platinum group metal complex start recovering post the end of September, which is positive. We also had no position on the positive side in Aspen, and with weak results this year, that's been under pressure. And we had quite a large position in Mondi, where we could still constructive in the stock. The market was pricing in no value for their Russian operations, and they've managed to sell those operations now and get cash out of Russia, which is positive for the counter. On the negative side, we had a position in Pick n Pay. We originally established the position on the back of load shedding. So the stock came under a lot of pressure because it has quite narrow margins. And with its cold chain, it has to run 24/7. They obviously spend a lot on diesel, and that put pressure on the results there. We thought that was an interesting opportunity because we took the view that load shedding would be alleviated by the back end of 24. Unfortunately, we underestimated the big structural issues in Pick n Pay. And with ShopRite really putting down the hammer from a competitive perspective, it's put a lot of pressure on the stock, and we've seen a change of management there recently. If we just take a step back and look at the market outlook and examine what has really been driving a lot of the stock market returns in South Africa year to date, first and foremost, we know load shedding has been a major problem. So load shedding really picked up halfway through 2022, as you can see from the yellow line there, and it's been unprecedented in 2023. So you can see in the red line there, it's higher than any year we've seen before. The good news is that if we look at load shedding on a monthly basis, so this is the terawatt hours of load shedding on a monthly basis, you can see it really picking up halfway through 2022, peaking in sort of April, May of this year, and now sort of coming off towards September, and we know it's alleviated more coming into October. Recently, 2 units of Kusile power station have come online, and together that's about 1.6 gigawatts of power generation, or 1.5 stages of load shedding, so that's positive, and we expect 2 more units to come online by the end of the year. So that's very positive for the electricity outlook, and we still hold the view that by the end of 2024, we should have seen the back end of load shedding. What's also been very positive is the structural change we've seen in the electricity sector. So I've spoken about this before, but remember, the 100 megawatt embedded generation cap was lifted in December 22, and what we saw is a big reaction from the private sector. And what's great about that is it shows that when government deregulates certain sectors, we see structural change and the private sector stepping in to solve some of South Africa's problems. So in 2022, we saw 1.6 gigawatts of embedded generation being registered. And in 2023, so far, we've seen almost 4 gigawatts of embedded generation being registered. Putting that together, that's about 6 gigawatts of power that's been registered by the private sector in just over a year, or 2 stages of load shedding, which is very positive. And we think this momentum continues into the future and helps solve South Africa's electricity problem. That would be very positive for the local markets and domestic-focused counters. Another big structural problem in South Africa has been logistics. We know that Transnet is struggling to operate. And over here, you can see a chart of Transnet volumes by millions of tons and how they've dropped off from 2020 down to where they are 2023. And that's overall general freight, coal freight, and iron ore, all areas under pressure. And that's because of Transnet struggling to operate, lack of locomotives, and obviously we know vandalism and cable theft across their network. What the government is doing is very interesting. They're also tackling this structural issue, firstly by setting up an asset management company that will really house all the state-owned enterprises. So that's a great first step. And that asset management company will have private sector board participation, which is great as well. That should help isolate state-owned entities from political interference, step 1, and also encourage private sector investment into state-owned entities. So for instance, in Transnet, we have seen a preferred bidder announced for a JV at the Durban container port. Just keep in mind that container port alone accounts for 46% of South Africa's container traffic, which is very positive. So they can really make quite a large difference there. We've also recently heard that there's preferred bidders being looked at to run the Johannesburg to Durban container line, and obviously that's the major general freight line for South Africa. So if we can get preferred bidders and private sector participation there as well, that could really help change the picture you're seeing over here. So this is the next sort of structural change that we're watching quite closely after electricity, and what we think can make quite a big difference. Just between electricity and logistics, that can add about 3% to South Africa's GDP. So for every stage of load shedding we see, that takes about 30 basis points of GDP growth of South Africa's GDP numbers. And logistics alone, this impact that you've seen here since 2020, is a cost the economy about 2% of GDP. So just by solving these two, we can get the economy growing at above 2% once again. Now, what's interesting about private sector participation is in this chart, the Eidelman Trust did a survey amongst multiple countries and looked at the trust citizens have in the government versus the trust citizens have in private business. Now, you can see the trust difference was the widest out of all these countries in South Africa. So 62% of the citizens of South Africa said they trust private business, while only 22% trust the government. And we think that speaks volumes. So if the government's willing to deregulate sectors and get private sector involvement for structural change and investment in these various sectors, we think that can unleash positive consumer sentiment and positive investor sentiment, where you can see generally South Africa trusts private business more than government. So this would also be very positive going forward. The big risk right now in South Africa, and it's often spoken about, is the elections in 2024. We know they have to take place between May and August next year. Right now, polls are showing that the ANC would probably drop below the all-important 50% mark, down to 48%. So there could be a coalition government, but it's definitely not our base case that the coalition is with EFF, which would be a large risk, but rather with a smaller party because there's only that 2% gap to get over 50%. What we find more interesting is the results that you could see in the various provinces. So at the chart at the bottom, you see we've taken the provincial vote in 2019, the results from that across the various provinces. We've then taken the local government elections in 2021 and the result across all the provinces. And firstly, you can see across the whole country, in every province, the ANC support has dropped. What's interesting is that it's dropped below 50% in Gauteng, KZN, and the Western Cape. It was already below 50%. If we then look at polls or estimates for the 2024 election in Gauteng, KZN, and Western Cape, there we can see the ANC support drops quite a lot. So in Gauteng, it goes to 40%, KZN also down to 40%, and Western Cape down to 13%. So what's interesting about that is we've seen what a different government can do in a province like Western Cape, where it's operating, we would say, slightly better than all the other provinces. And with the KZN vote for the ANC only at 40%, the coalition between IFP and DA will probably lead them to controlling that province, and we'll probably see a coalition government in Gauteng. So those three provinces likely no longer controlled by the ANC government. If we then overlay where GDP is generated for South Africa, we can see 63% of the GDP in South Africa is actually generated out of those three provinces. So what's interesting about that is post the 2024 elections, there's a high likelihood that the majority of the GDP in South Africa generated in those three provinces will be controlled by a new government, and we can see different institutional change and different structural change in those provinces, which could really drive GDP recovery there. And we think that could be quite positive from an election outcome. If we then overlay the valuation of the South African markets on top of the structural change I've just discussed, over here we're looking at the forward PEs for various MSCI markets, and you can see the forward PE of MSCI South Africa used to trade in line with developed markets and at a premium to emerging markets. Since 2018, it's derated and now trades at a discount to both emerging markets and developed markets. In this environment, with the structural change that we think can drive GDP growth, we're finding very interesting opportunities on the local stock market. If we then delve deeper into the market and look at companies that are really SA focused and look at their valuation, this is their forward PE, you can see they're trading well below their average and 2 standard deviations cheap from their average. So in the local sort of domestically listed companies that are focused on SA, we're still finding very interesting opportunities. And we think there's a lot of pessimism priced into the market. So any structural change and change in GDP trajectory should really drive the earnings of these companies. So the question is then, how have we positioned the fund to take advantage of this? Firstly, on the global consumer side, we still have big positions in Naspers Process. You're buying Tencent, which we think is a great asset, at a 40% discount by investing into Process. Still a decent position in British American Tobacco that generates an 8% sterling yield, and you should see mid-single-digit earnings growth out of it. In the South African financial space, we had large positions in insurers that have done very well for us. We now think the banking sector looks very attractive. A bank like Absa trading on an 8% dividend yield, 6 forward PE, and we think well managed with a balance sheet that's well provided. In the SA Inc. space, are really companies that are driven by the local economy. We're more opportunistic and we're looking for companies with good balance sheets, good management teams that can take market share. Over here, we have a position in Foschini trading in a 9 forward PE with battery backup systems in most of their stores. They're relatively resilient and we think they should show good earnings growth going forward. In the resource space, we have selective resource exposure. So in the diversified space, we have a counter like Anglo American, still trading on a decent free cash flow yield. In the oil space, we have Sasol, which obviously benefited from the high oil price this year. And then paper and packaging, and mentioned, still a decent exposure to Mondi. And there we think it's trading quite cheap. And on top of that, you get value unlocked from it selling its operations in Russia. From a sector exposure perspective, you can see 28% of the fund is still exposed to the global consumer. That's Naspers Process, AB InBev, and British American Tobacco. Still decent exposure to the banking sector with 19% of the fund there, and about 31% of the fund exposed to the resource sector, about 12% of that in diversifieds. We've got another 6% in oil and gas, 6% in paper and packaging, really through Mondi, and then decent exposure to precious metals with about 8% in platinum and gold. On a geographic exposure, about 33% of the fund is exposed to developed markets. Only about 31% of the fund is exposed to underlying SA Inc. drivers. But what is interesting here is there's another 11% of the fund that's exposed to South African or companies that operate out of South Africa, but that are really dollar earners. That would be like resource counters. And then about 18% of the fund exposed to emerging markets, and that's really to China through Naspers process. In conclusion, this is the top 10 positions in the fund. You can see the fund relatively concentrated with about 63% of the fund in the top 10 positions. That being said, we still think well diversified and very nicely positioned to generate great returns for our investors going forward. Thank you very much.